Welcome back. I'm Rick Barnett with Barnett Financial Tax, and today we're talking about your retirement, all the things you've saved for, worked so hard for, invested money, made plans, set aside time to put those plans in motion, and we're excited to talk to you about some of those nuances and some of the challenges you're going to face. You want to leave a lasting legacy. The challenge is there's a ticking time bomb in your retirement plan. And this ticking time bomb could cost you and the next generations a lot of money in taxes. What I'm referring to is what's called the required minimum distributions that we're all going to have to pay taxes on in our 70s with all of our accounts like IRAs, 401ks, 403bs, etc. And if you have those accounts, then you will be forced to take the money out, even if you don't need the income, and pay tax on that in the days to come. The real challenge that we'll talk about in just a second is the amount of taxes that will be due in the future will be great. And by the way, if you don't take the money out, the penalties are steep. Under the current law, if you fail to take your required minimum distributions, the penalty is 25%. For many, RMDs are a necessary part of your retirement plan, meaning you're going to need some money in the future. Once the RMDs are going to be coming, you're going to use that money to continue to fund your retirement, maybe even plan some additional vacations, going to see the kids. Maybe there's some time you want to spend in a warmer climate, and we're spending some time in the winter. And so these are some of the things that people will be using for their RMDs. But as I mentioned, there are some challenges, and here's why. If you're forced to take that money out, then you're thinking, what do I do with it, right? And there are a lot of great things besides just spending the money that you can do. So you take the RMD, you pay the tax on it, and then what's the next step? And that's where a great financial plan can come into play, because there are things you might need to fund for the future, things like long-term care. Do you have a long-term care plan in place? In the event you need care at some point in the future, how will you pay for those things? Additionally, you can plan ahead and be thinking about, how can I pass my wealth on to the next generation in the most cost-effective, tax-wise manner? So how do we outsmart the RMD challenge? Meaning, how do we make a lasting legacy plan out of these required distributions we're going to have to take? So here's a few of the strategies. One is what's called a qualified charitable distribution. These are QCDs. And if you've never heard of this before, it's a way in which you can take money from the IRA, meet the requirements of the RMD, and pass that money directly on to the charitable things you've already been contributing to. It could be a church, it could be a charity. As long as it's a nonprofit organization, you can do a QCD, meaning you don't have to take constructive and physical possession of the money that's coming from the IRA. It can go directly to the entity, which means you pay no tax on it, and you're able to continue to take those distributions, not pay tax on them, but meet the requirements or the obligations you put on yourself for these qualified distributions. The other thing is, and I'm sure you've heard of this before, is convert that 401k IRA money, 403b, into a Roth IRA. And so when you look at those techniques and strategies, I think everyone's heard of converting Roths. The question is, how much should I do on an annual basis without blowing up my tax return? Where do I put the money once I'm making that decision to move it into a Roth? But you'll accomplish a couple of things. Number one, you'll be building tax-free income for yourself in the future and have that bucket of money inside that great Roth or tax-free tax bucket. Secondarily is, once that money goes to the next generation, then they won't have to pay tax on it either. It's a great technique. Make sure, if you don't work with someone who's really well-versed on not only how much Roth conversions you should be doing, but figuring out the tax part of that deal as well. The other technique is just to get that into a non-qualified account. It could be a brokerage account, it could be savings, but you're basically going from an IRA you're required to take that money, you've paid the tax on it, and so you're thinking, okay, I need to shore up my savings account for things we need to do. I need to add some additional monies into a brokerage account, investments, and those are kind of, you pay tax as you go type of accounts. So maybe not as good as a Roth, but it definitely can accomplish some short-term goals. So non-qualified accounts is also a good place to put that required minimum distribution. And finally is life insurance. And I know people over the years have said, I don't like life insurance. So I think the reality is people don't like paying for life insurance. But when you consider the benefits of life insurance, which include tax-free death benefits to beneficiaries, tax-free growth of any dollars that are accumulated inside the contracts, there are some great benefits. One of the greatest tools you can use life insurance for is legacy planning, because in simple terms, you can take pennies and turn them into dollars for future generations. If you already know in your financial plan, your retirement plan, you're never going to spend all the money you have based on the amount of wealth you've accumulated, then you should be considering a legacy plan, which means I'm going to figure out the best way to get the most dollars into my beneficiaries' hands tax-free. And life insurance is a great way to do that. The bottom line is RMDs do not need to diminish your plan, your income, any of your investments. It should be part of your strategy already, whether you are planning to retire in the future or you're already there. A solid retirement plan will already have taken this into account. How much the RMDs will be in the future, what type of tax will you be paying, those calculations should have already been done. If not, we invite you to have a call with us, come visit us, and have that conversation, because we're really trying to outsmart this RMD that's forced on us, right? The IRS tax code says, hey, for most people at age 73, you've got to start taking that money and you have to pay tax on it. So we need to know the impact it's going to have. And then most importantly is, what are we going to do with it? Here at Barnett Financial Tax, we use what's called the Barnett Advantage, and that advantage is we're pairing the financial advisor with our CPA to go through all of this planning to get it set out and put into a roadmap so we know exactly where we're going and when we're going to get there. And this is a great way to outsmart this and get ahead of it, therefore making your retirement plan the best it can possibly be. Give us a call at 1-800-425-7044. You can email us at myteam@BFTWealth, or look us up online at www.bftwealth.com, and I look forward to talking to you soon.